We've got Geoffrey Dennis, independent emerging markets commentator, joining us this morning. Geoffrey, thanks so much for taking the time. And comments about what you thought of Nvidia's results and what it means for the ongoing AI-related trade.
I don't really follow the individual companies that well, but obviously Nvidia continues to grow, and I think that's very important. But I think the market is somewhat split now between investors who are still very, very bullish about the tech sector and specifically the AI sector, and those who are very worried about the capex that's going to have to be put in place, particularly on data centers. And I think that's the worry people have. Also, investors have got a lot of worry about all the cross holdings of assets that are building up within some of these leading AI companies. So I feel basically there's nothing here in the Nvidia results that's going to cause this AI bubble, which is a bubble, to pop. But I think investors generally are a bit more cautious now, and I think it'll become harder as we go forward for there to be positive surprises from the AI and from the big tech companies. And this is why I think you'll probably see some of the more traditional sectors doing a little better as we go forward.
Geoffrey, good evening to you. Because AI is still front and center, if you will, what did you make of, or what are the rumblings that you heard of this India AI summit? Because anybody except for Jensen Huang, of course, was present there. And if India was told as or spoken about as one nation or one economy which didn't have an AI trade, this kind of put that to rest, if you will. Do you reckon flows in some fashion because of the underperformance of 2025 and because of now some foot in the door in the AI trade could well happen in India, or are valuations still a problem?
I don't think valuations are a problem, particularly, especially after a very disappointing 2025. And I don't think that suddenly creating one or two AI companies in India are going to be the thing that really pulls people back in. Although, of course, if you were to see some large listings of AI companies, I think that would be pretty good. But I think India from here on is going to have to move based on more conventional fundamentals, I think. The valuations in relative terms to EM, and in particular to China, have pulled in quite considerably given the poor performance in 2025. I know inflation's picked up a little bit, but real rates are still positive. There may be room to reduce interest rates. The fiscal side seems to be under control. So I think we just need a trigger here to get some of these foreign flows in. Now, meanwhile, while Korea is blowing the doors off and while Taiwan is also doing very well, we're not sure what that trigger would be. And certainly I don't see AI specifically at this stage anyway being a catalyst. It could be down the road, but obviously it's nice to see an AI summit in India, but I think we got a ways to go from that to India's AI sector specifically attracting a lot of foreign money into the market.
Geoffrey, last thoughts on this whole tariff conversation, because you're obviously going to see back and forth between all of the trading partners of the US, and the news, of course, over the weekend and at the start of this week was that those 15% tariffs did not come into force. The latest update, of course, is that they're going to try and do it where applicable. And this seems to be a climb down from what was stated over the weekend. How do you see this panning out? Do you think that this is something that we can finally put in the rearview mirror?
Oh, I don't think so. I think it's going to continue to be a source of volatility, frankly, within the markets generally. Now, I think it was no surprise the Supreme Court knocked down the previous tariff regime. And then, of course, what they did is simply refer to a different law for Trump to be able to announce these 10% tariffs, which then he said would be 15. And now he's saying maybe it's only going to be 10. And of course, as I'm sure your viewers know, this is a law that only allows these tariffs to be general tariffs at a 10% level to be in place for 150 days, 5 months. And so, between now and then, you've got to get Congress passing a bill or, getting an act passed and signed by Trump to get them being more permanent. And I think that's going to be very, very hard to do, especially as we push up towards the midterms, where frankly, the Republicans are increasingly unpopular around the country. So I just think, the White House is committed to tariffs without any question. And if these are rejected again, or they run out of room because the 5 months are up or whatever, I'm sure they'll try to find something. We've got sectoral tariffs, steel, of course, is a good example, autos, but general tariffs on individual countries, we're now relying on a different act from history, and how long they can sustain that, given the 150-day limit, remains to be seen. But I'm afraid to say this book is not over. This book is not finished. It's going to continue to be a source of volatility, I think, to markets as we head through 2026.
At some point, I hope that we can shelve that book. Thanks so much, Jeff, for taking the time for speaking to us. Pleasure speaking with you as always.